I think the environment that we're in today is a normal environment from a historical perspective. Certainly, interest rates, while much higher than in recent past, is still fairly low by historical standards. And to give you an example of that, when I first started my career in private equity, the 10-year treasury rates were yielding just over 6%. And in the first half of my 26-year career, it was usually above 4%. And that's right around where we are today. It's just that it's compared to a prolonged period where it was below 3%. So it feels abnormal. But from a historical perspective, the current environment, in my opinion, is quite normal. The financing markets also, after a sustained period of robustness, has returned to some of the normalcy that we saw in the late 90s, early 2000s. And again, it just feels uncomfortable, largely compared to the recent past. What is abnormal, however, is the inflation rate. The inflation rate, core inflation, is still sustained above 5%. And this is after a period of upward wage pressures. There's been a step function change increase in the cost of labor, and companies have had to mitigate that by increasing prices. And with higher interest rates, the consumer will continue to be under pressure with higher credit card payments, higher car payments, and soon, if not now, higher mortgage payments. And so we see, we believe there'll be sustained pressure on pricing for not just the consumer, but the economy overall. And we see this environment persisting for the foreseeable future. And again, in our minds, it's not an abnormal type of environment. Frankly, it's more akin to the environment that we experience in the 90s and most of the 2000s. And people will have to get used to this environment rather than waiting or hoping for a return to the recent experience in the recent history.